Okay, let's just jump right into this explainer. We've all been told our whole lives that saving money is the absolute ultimate sign of financial maturity, right? But here is the stark truth. Being a diligent saver might actually be the very thing holding your financial future back. So we're going to explore why saving money alone is almost never going to make you wealthy, and more importantly, how to break through the psychological barrier that keeps you stuck there.
Picture this scenario for a second. You do the responsible thing. You discipline yourself, skip the extra takeout, and stash away a couple $100s every single month. You're feeling super responsible, totally in control.
Then one day you open up your banking app and boom, there it is. An impressive $10,000 sitting safely right there in your account. You've officially built a solid safety net.
But then you look a little closer and you realize something incredibly frustrating. That 10 grand is just sitting there earning a tiny, basically invisible, 0.5% interest rate. Do you know what that actually means? It means after an entire year of incredible discipline, missing out on fun purchases, and doing all the right things, your $10,000 has earned you a pitiful $50. Yep, $50 for 12 whole months of financial responsibility. So seeing those returns right alongside those everyday headlines you read about massive stock market growth naturally sparks a pretty vital question. You start wondering, wait a minute, am I doing this wrong? Because clearly saving money is a good thing, but it hits you that saving alone just isn't building any real wealth. And honestly, this is exactly where so many people get permanently stuck.
The absolutely crucial point here is understanding that saving and investing have two completely different jobs, like fundamentally different. Saving is meant to protect your money. Investing is designed to grow your money. Saving isn't the finish line, it's literally just stage one of the whole shebang.
Think about the math over a 20-year timeline for that exact same $10,000. It's actually staggering. In a typical savings account earning 1%, you're left with just over $12,200. But if you invested in the stock market, which historically returns about 10% on average, that exact same money skyrockets to roughly $67,000. Same starting money, but a completely different life outcome.
But here's the fascinating part. The biggest wealth gap out there, it isn't actually about the math at all. It's all about psychology. Most people never make the transition to investing simply because saving feels perfectly safe. You log in, you see it, it never randomly drops 5% on a random Tuesday. Investing feels risky. The market moves up and down, and that emotional volatility literally scares people away from building their wealth.
Let's move on to the 4-step path, how to safely transition from saving to investing.
To make this leap safely, you really need a roadmap. These are 4 clear, super anxiety-reducing steps that get you into the market without risking your everyday financial security.
Step 1 is totally non-negotiable. Build a real emergency fund. Before you invest a single dollar, you need 3 to 6 months of living expenses saved in cash. This money stays in savings. It is not for investing or chasing the next big opportunity. It is strictly for job losses, medical emergencies, or a suddenly busted transmission. That fund protects your investments from the chaos of your own life.
Now, step 2 dramatically reduces your emotional anxiety by separating your cash into 2 mental buckets. Bucket 1 is your safety money. That money does not move. Bucket 2 is your growth money. When you mentally write off your growth money as funds that are fully expected to bounce around over time, it totally frees you from stressing over daily market dips, because its long-term job is simply to grow.
Step 3 is to just start small. You know, a lot of beginners have this illusion that you need thousands of dollars to start investing. You definitely don't. Loads of modern brokerage platforms let you begin with just 50 or $100. The goal isn't to make massive profits your first week. The goal is to build the habit, because building the habit matters way more than trying to perfectly time the market.
For step 4, focus on simple investments first. Avoid the complicated day trading or crazy crypto speculation. Seriously, the simplest investments, like index funds, usually outperform the complicated ones anyway. They track the overall stock market, instantly diversifying your risk by buying tiny pieces of hundreds of companies all at once. It's simple, it lowers risk, and it absolutely works.
And hey, you don't just have to take my word for it. Warren Buffett himself repeatedly backs low-cost index funds as the absolute smartest play for the everyday person. It turns out boring, consistent investing is actually the most powerful strategy you could possibly use.
Next up, the magic of compounding, which is exactly where your money starts working harder than you do.
So if you invest just $300 a month at an average 8% return for 25 years, you're going to end up with roughly $285,000.
But here's the absolutely crazy part. You only actually contributed $90,000 out of your own pocket. A massive $195,000 of that total is pure compound growth. That is compounding working massively in your favor. It's like magic for sure.
But inevitably, whenever we talk about investing, this uncomfortable question always pops up. What happens to your hard-earned growth money when the stock market takes a nosedive? Because let's face it, investing feels uncomfortable at first, news headlines get insanely dramatic, and people naturally tend to panic.
Well, this is exactly where discipline separates the real investors from the gamblers. Surviving volatility requires knowing that market crashes are historically entirely normal. They've happened dozens of times. More importantly, long-term investors actually benefit from downturns. Why? Because your consistent monthly contributions just end up buying way more shares at lower discounted prices. It's like a stock market flash sale, leading to massive gains when things eventually recover. Experienced investors stay perfectly calm because they think in decades, not days.
Think of it like this. Saving money is a lot like keeping a handful of seeds perfectly safe in a glass jar on your shelf. Sure, you protect them, but absolutely nothing grows. Investing is taking those exact same seeds and burying them in the dirt. It's exposed, it gets a little messy at first, but over time it takes root and yields an incredible harvest that's way bigger than what you started with.
As we wrap up this explainer, the data and the psychology really make one thing crystal clear. Saving money gives you that much-needed stability, but investing is what actually buys you your freedom. The earlier you can strategically combine the two of them, the more powerful your financial future becomes. So the final question you've got to ask yourself today is this. Are you currently just stuck in the saving stage? Are you finally ready to conquer the next step and build your freedom?